talk a little bit about the global situation so you get an idea of what we're dealing with globally. Let's talk about what's going on down the farm. Many of you very well know the challenges that are going on the farm. And we'll focus on wheat primarily. I also have slides on corn and soybeans, and depending on the time, we'll see how that goes. But let's dive right in. You know, I got all done with this presentation, and I sat down and I thought, well, let's talk about the risks and opportunities. We all know the challenges. We all know, we've all heard the gloom and doom and all those sorts of opportunities and the risks. So let's just talk about that and kind of set the stage where we go up front. You know, the risks, I don't need to read all these to you, but I do want to highlight a couple of them. Most of those are not new, but I will say, and you mentioned the Trump rally. President-elect Trump has added a lot of uncertainty into markets, uncertainty in our political system, and so I think we need to be very cognizant of what's happening in trade policy, and also when you look at it from a corn perspective and oilseeds, also what happens with renewable fuel standards. That's going to have a huge impact on what prices could do in the future if those made changes. But at the same time, I think there's some opportunities that we need to think about and not forget. And I'm going to say this as someone who's been in agriculture for 30 plus years. You know, we've grown grown corn and wheat and potatoes and sugar beets and whatever the case might be, and basically said that's what the consumer, here's what we're growing, here's what you're going to eat. And the consumer's pushing back on us now. Now we may disagree with what they're pushing back on us, and that's okay. But the fact is that's what the consumer's wanting, and that's what the consumer's willing to spend money on to buy from us. And so we've had a lot of discussions internally within the bank and also with clients and also with potential clients about different opportunities in the marketplace, whether it's non-GMO, whether it's organic, whether it's, I can talk about meat substitutes, and we talked to one who needed a pea protein. And all these things we grow here and they're being imported in the United States. We can grow that here and is that an opportunity? And if the consumer is willing to pay us for that and we can make money, then I think it's something we need to think about. But you can see some of the risks and opportunities there. So use that as a backdrop to think about going forward. Let's look at the macro world of what's going on in grains and oilseeds. When you look at the last 4 years, and that's really what we need to think about, is we've seen a growing number, stocks continue to grow year after year. They're not growing as much or project to grow as much this year, but this is the fourth year where we've seen major growth in corn, soybeans, wheat stock and coarse grain stocks in the world. This is a huge, huge change from where we've been. You can see as we go from 2012-13 back, you can see we had lots of ups and downs, and we weren't gaining stocks, we were losing stocks, so we saw that price volatility, and we all benefit from that. Well, the things change now, and now we're catching up with each, and we're building stocks each year. That's what's driving our prices. And this is the other piece. If you look at global stocks use, this tells you one thing very quickly, is that we're producing more stuff than the demand is right now. So we have plenty of stuff in the world if you have it. Corn, soybeans, potatoes, everything that you can imagine, we have plenty of it. And you can see that in the stocks to use ratio going forward. One thing, I showed this slide last year, and I just wanted to show this again to show that there are a lot more competitors in the world than we used to have. And so we have to be sharp, our pencil has to be sharper than it's ever been before to make sure that we stay competitive in the world. The dollar's not helping us, and I understand that, but we have to be able to show to folks that we're the most reliable, we always have the supply, and we'll get it to you the way you want it when you want it. And we have to be able to sell ourselves to the world that we can do that. Is that always the case when you look at the Black Sea? Is it always the case when you look at Europe? And sometimes South America. You look at our partners, Canada, Australia, the United States, we can get what you want, when you want it, and how you want it. And so we need to make sure that message gets out. The dollar is a challenge, and there's no question about that. And we could spend the whole morning talking just about what's happening with the dollar. This is a long-term chart, this is a monthly chart, and you can see on the very far right-hand side of that chart that we have broken out of the upside. And we've broken out of a pretty long term, we've been in a range for quite a long period of time. And now we've broken the upside, and that's a function of a couple things. One is renewed confidence in the U.S. economy, and the economy is better, and it's getting better. Also the fact that interest rates are going to go up and the anticipation that interest rates are going to go up. And so as we see that, the dollar is going to be a challenge for us in agriculture as we try to export our products. This is from the December FOMC meeting. This is what the governor said as far as what they think interest rates will do over the next 3 years, or 2 years actually, now we're in 17, and a little longer term. And you can see, as we've expected, they're going to go up. But you can also see in the longer term, their high is only about 4%. So it's not like we're going back to those double-digit numbers we saw in the 1980s. But we are going to see higher interest rates. That's fueling the dollar. It's also fueling people making decisions about making interest rate swaps. We see a lot of that in our client base wanting to put interest rate swaps and to try to, put a floor in their, a ceiling, I should say, on their interest rate exposure. So that's going to have an impact on your business and your profitability going forward. But still, they're very low rates than we've ever seen before. So let's get a little bit closer now into what's happening globally, or what we see happening back home. And the numbers you see there are our forecast for acreage for corn, soybeans, and wheat next year. You can see corn's down and wheat's down again, soybeans up a little bit. Now that's being driven by lots of different things, and we'll talk a little bit more in detail, but the fact is that we have a lot more corn than we need. We need to probably take out about 400 to 500 million bushels of corn, and I'll show you that graph a little later, to get the stocks to use ratio in a place where we see $4 corn again. Also, and that means about 2 to 3 million acres need to come out of production when you look at current trend yields. So corn needs to come out. The other reason for that is it's very expensive to plant corn. When you look at soybeans, it's cheaper to plant soybeans. The demand for soybeans and prices have been better. The soybean to corn ratio is encouraging all to plant more soybeans. So we expect about almost 85 million acres of beans. There's some numbers as high as 86, 87. Wheat is the challenging one. We expect wheat to come down again next year. We do think wheat acres will bottom out next year, because as wheat acres bottom out, prices will start to come back up, and that will encourage acreage to come back. Most of that is in hard red winter wheat, and we'll talk a little bit more about that a little bit more later. There is the hard wheat acres, both hard red winter and HRS, or hard red spring, and you can see most of that's coming out of hard red winter. HRS has the demand for that's pretty good, partly because of the higher protein and the need for protein, and we'll talk a little bit about that later, but I just want to give you that tidbit coming down the line. So what's happening down the farm? We all know the challenges. I don't want to spend a lot of time on this because we all know this, but I want to at least make sure that we're all on the same page. This is kind of where we are in the cycle, and you can see there we have 16 labeled out. We're probably near the bottom of that cycle. We're running out of operating capital. We've got to make decisions, and that's going to come back to planning decisions. We need to reduce acreage to become more profitable, to lower those stocks, and also give prices the opportunity to go up. So it's kind of, I kind of talk about this as the grief cycle a little bit. We've labeled it the crop cycle, but we're kind of at the bottom of that trough, and people now are going to be making decisions about where they're going to allocate their capital, what they're going to plant, what does the future look like, what are they going to do different on the farm, and that's the one thing I want to encourage you is that, this is from a teenager, so keep this in mind. He said to his dad, he said, there is no box anymore, Dad, so you can't think outside the box. There is no box. I encourage you to think about that and think about where you are in your business and how are you going to move your business forward so that it's economically sustainable and viable going in the future. We also have a lot of questions about farmland values and also a lot about cash rent. And also the question is, well, this is like the 1980s. I looked at this a little differently, and I didn't put this here because it was a little bit crude, but you can see I've got the 1980s, and these are Iowa farmland values. And you can see the sort of decreases or year-over-year changes we had in the 1980s. We're seeing nothing like that today. Are we seeing decreases? Absolutely. We probably think another 5 to 10% down on farmland values. You look at the heart of the Corn Belt over the next 3 years. But we don't see, they're not decreasing at that rate, and we don't see that big drop-off yet coming. People generally are in better condition today than they were back in the 1980s. But when we look at where are we going forward, and this is also coming out of the work we've done when we look at our modeling as far as crop acres, prices, demand, and stuff like this. This is coming out of that, looking at margins. We expect margins to be negative again this year and probably negative again in 2018. In 2019, we start to see the light at the end of the tunnel. We expect that by that time we'll see some adjustments in acreage, we'll see some adjustments in planting acreage, and also we'll start to see some positive margins coming back. The worst case would probably be a break even, but potentially in 19 and 20 start to see margins be a little more positive. One of the things I wanted to talk about down the farm is just highlight this just a moment, is just talk a little bit about organic. We've had a lot of questions both from farmers, we've had questions from food companies about organic and what's happening. And you can see that we continue to see increases in acreage, and the numbers are a little bit scarce and you have to work pretty hard to get at some of the numbers, and you can see the data set is not as complete as we'd like, but we do continue to see growth in that field, in that area, both from farmer interest and also from consumer interest. But you can also see, and I'm going to focus on wheat, we see a premium for organic products on the shelf at the store, and so we see that coming all the way back into the farmer's pocket. And you can see the blue line is the annual received price for wheat. The green line is what you're seeing for feed wheat, and you can see that premium remains very strong, and we expect that to remain that way. Now, we do see an interesting phenomenon is that when you look at feed wheat, also have Canada in there, you start to see a convergence of all those prices. Now that doesn't mean that you're seeing, as I go back, you still see that premium, but the fact is you're seeing quite a convergence in prices as these can't come together. And I will tell you, we're not exactly sure why that's happening, but the fact is they are coming together, and it's something that's, I think, to pay attention to and look at where your potential premiums could be in that marketplace. It's usually going to be in the food side, not the feed side. But at the same time, you continue to get that premium over what you would get for conventional or conventional wheat in the marketplace. The other thing I wanted to point out before we move on is that we don't import a lot of organic wheat products. We do import a little bit organic durum, most of that coming from Canada. But here's the opportunity is in corn and wheat, and corn and soybeans. This is sort of a kind of a dumb moment for us. We kind of look at this and think, well, we can grow corn and soybeans here. We do that very well, and why aren't we doing that? Most of this is coming from Eastern Europe, and we kind of wonder about the origins, and you know how the organic people, and you know this very well for those of you in potatoes looking at the food chain, how serious people are making sure that they understand the food chain, that the food chain's documented, and we can identify where they come from. And with this, we kind of wonder. So I think this is opportunities for U.S. farmers to look at potential. And we know people are doing this. We know it's difficult, and there needs to be some more work done both at the farm level and also at the food side to make sure all those parties come together. But I just wanted to show this as one of those things we look at and go, wow, that's an opportunity. I put this up here, and this was done by our COO, Kurt Hudnut, in St. Louis, and he did this at the DTN Ag Summit. And I put this slide in because I wanted to talk to you a little bit about, in his title of moving beyond a price taker and a cost taker. You need to be don't let the market manage you, you manage the market. And you can see he's listed a number of different things there to help you do that. And I won't read them all, but a couple I just want to highlight. We see a lot more opportunities with farmers coming together, not unlike co-ops, and trying to bring their demand together as far as their inputs. What can they do for inputs to get a better cost up front? One of the things that we've noticed is farmers, with all the storage that's been built across the Midwest primarily, is that they've become a lot more like elevators. And if you're more like an elevator, you need to manage that basis levels. So that's really, really important. Understand basis and know how to trade it and how to manage it. There's a huge opportunity there that you could pick up 2, 3, 4, 5 cents a bushel. You'll never pick it up on the futures. The futures is just so volatile and difficult to deal with. When you look at basis, you have a lot more opportunities and something you can manage closer to home and understand. And if you want to talk about that tomorrow, we can certainly do that in the booth at 2 o'clock, or this afternoon at 2 o'clock. So I think there's lots of opportunities, employing professionals, also partnering with people to get those potential niche markets. Food companies are looking for opportunities like that. So think about all these, get beyond being a price taker and a cost taker. So let's dive. I got about 10 minutes left, so we're going to focus on wheat, and then we can talk about corn and soybean and give you a couple quick tidbits on that. The wheat market, as you all know, has been challenging. It's been the most challenging of all the major grains and oilseeds. And again, I kind of like to look, and those of you who were here last year saw this, I look at the bulls and bears, and you can kind of see that I have a little evenness there, but the fact is we just have so much wheat in the world, and in the U.S. to get through. Now the challenge or the opportunity in wheat is on the protein side, and I'll show you that in a minute, so I want you to just remember that as we go forward. There's the U.S. balance sheet. Sterling may be watching online back home in St. Louis. He hates when I put this up, but I do want to point out to you, you've got the 17.8 or the 17.18. It's mislabeled. I apologize. It should be 17.8 there on the left and the right side is our forecast going forward for wheat. So we do start to see stocks come down in 17.18, probably because we're seeing a contraction of acres. Don't know what the yields will be, but we've put in a trend yield there. But see the opportunity, and we start to see maybe a little bit of relief on the wheat side of what's happening. I just wanted to show that. The challenge is going to be HRS. That's where the opportunity is as well. You can start to see the same way. We start to see a decline in stocks, and that's where the opportunity is. And when HRS stocks start to get tighter, that's when you start to see these explosions in wheat prices and also explosions in basis and the opportunities there. This is our forecast for wheat prices in Chicago and the Matif, if you're interested, if you do any trading in Europe. But you can see, we do see them coming up from where they've been, kind of that mid $4 area, and this is Chicago wheat. This is not Kansas City or Minneapolis. But you can see, we see over the year a slow trend upward going forward. Now this graph, let me stop here and explain it just a little bit. This is coming out of our general equilibrium model, and we're looking, it's a stochastic model, so it's looking at the probabilities of price. That middle line you see there is what the model puts out as far as prices. So that's the definitive number if you have it. But if I want to focus you on the green line, which is 75% percentile. So what that means is that you have a 75% chance that prices will be at that level or below over the next, in this case, over the next 5 years. You only have a 25% chance, or actually it's only a 20% chance that it'll be higher than that. So you can see that the downside, there is some downside, but not a lot, but the upside is limited. The probability of an upside is very limited. And that 95 percentile is basically, we've shocked the model for a drought. So you can see you get back up in that 6 to 650 area, but again, that probability is pretty small. But it does give you an idea where the potential prices could go going forward. So again, if you have questions about that, we can talk about later this afternoon. We also looked at, in the model, we looked at that and said, what are the probabilities based on price, and also if in weather situations, what happens to acreage? And you can see the dark line, of course, is the definitive number where we think acreage will be. This is all wheat acres. And you can see that there is quite a wide range there. And that's going to be dependent on weather, it's going to be dependent on price, dependent on alternative crops and what the possibilities are for other crops. So you can see a little wider divergence there. So I should say one thing. You can see how close these lines are together. Gives you the idea and gives you the thought that probably the volatility in wheat prices won't be great. But I just wanted to point out the differences so you can see how with wheat acres, a lot more possibility, which will drive prices going forward. One of the things and opportunities in wheat has been the protein side. We had a great wheat crop last year, particularly in hard red winter, but the problem is it was low on protein. And so you can see the red line here. This is the spread between Minneapolis and Kansas City. This is futures. And you can see that this spread is out to has been as high as $1.50, $1.60. And you're going, okay, I don't trade the spreads, and what does this mean to me? What it means is there's opportunities in the protein side. So do you want to grow for yield or do you want to grow for protein? Because people are willing to pay for protein. We have plenty of wheat in the world. A lot of it's feed quality wheat, but if you have high protein wheat, someone's willing to pay you for that. And so this is where the opportunity is. And so what this is telling you is that with the Minneapolis being, and that spread going so far, there's a big demand for hard red spring wheat because it's a higher protein wheat. And bakers need that protein and need the quality of the protein so they can have their product perform the way it is. So want you to just bring that to your light to think about, go study it a little bit more and think about where you want to go with your operation, what kind of wheat do you want to grow, and what the opportunities are for you, whether it's yield or protein, or quality of protein, and that's referring specifically to the gluten. You can see, and this is also in the protein, this is Kansas City 12% protein basis levels, and you can see that we got down to a very low level this summer, Makes sense when we saw the big crop come in, and we kind of bounced around, but we had a big carryover of hard red winter wheat, so we had some of that a little higher, better quality protein in the marketplace that kind of kept those basis levels under pressure. But you can see now, seasonally they're coming up, and you'd expect that, and at the same time we're seeing those prices come up a little, and we're seeing those prices come up. But as we go through the year, we expect those basis levels to come up even more, or that protein premium to come up more as the quantity, or the supply, if you have it, of protein quality wheat diminishes. We've had a lot of questions about exports, and that's part of the reason we've seen prices, particularly in corn and soybeans, wheat to a little lesser extent, be a little bit better this year. And people go, oh, we're going to have great protein, or great export growth. This is true for both corn, wheat, and soybeans. Yes, they are up 26%. Corn's up a little over, I have to 18%, and wheat, soybeans are up about 80%. I may have those numbers turned around, and I'll get to those. But the fact is, we started off extremely strong because we didn't have the quality wheat in the world. Europe had a problem. Australia crop, of course, is just coming out. And so we had a problem in the world. And so the world came to the United States because we had quality wheat. But you can see now that we've come back into the seasonal down period. We had a pretty good wheat inspections yesterday. We had good wheat inspections 2 weeks ago. We were down yesterday, and that's not on this chart, but we're still running about 26% ahead of last year. We expect that number probably will diminish a little bit over time. So the wheat export side will probably, we'll see a little bit less wheat exports as we go forward. But you can see we have record wheat stocks in the world, and I won't dwell on that a lot. The same is the case in the U.S. But you can see we have a lot of competition in the world, and so it's getting us back to that. We have quality. We can get it what you want, when you want it, at the price you want, and so we can work that out. But you see, we have a lot of competition in the world, and you can see Europe was down last year, and we benefited from that, and we saw our exports come up accordingly. So you hate to hope for someone else to have a bad crop, but that has benefited us over time, and so that's why trade is extremely important, and what we can do and how we perform is important. And there's record U.S. wheat stocks. We're down a little bit this year, but we still have pretty good stocks level overall. And you can see we're in the upper quadrant of where we have been historically. I've got about 3 minutes, and so I'm going to spend just maybe a little time talking about corn and soybeans, because wheat is primarily where you're going to be dealing. But just talk about corn and soybeans. When we look at corn, and let me find the chart that talks about price. When we look at price going forward for corn, we don't expect a lot of upside on corn at this point. We're still going to be below $4 primarily overall when we look at where we're going. And as I said earlier, we probably need to see about 400 to 500 million there. We need to see about 4 to 5 million bushels less to get that balance sheet back in a little better place where we start to see $4 corn. And I point your eye to that upper demand curve. So we need to lose that. It's about 2.5 million acres when you do the back of the envelope math. So I think with corn, a lot of people said this is the sleeper commodity this year. I don't know that I would say it's a sleeper commodity. We are going to see a decline in acres, but the fact is we have lots of corn. We have over 2 billion bushels in stock, so we have plenty of corn to get us through this year and to get us moving forward. So we don't see corn prices getting back to that $4 at least for another year or two going forward. Corn, the biggest risk on corn is the RFS. If the new administration comes in and takes away the RFS, and Sterling did some modeling on this, when we looked at what that would do to prices, it would put us back in that old price range of $2 to $3. So the RFS is very important because we're using 40 to 45% of our production goes into, bless you, Jerry, goes back into it goes into corn 40 to 45% of corn production goes into ethanol production. So it's an incredibly important piece to the corn S&D going forward. So something to think about and worry about going forward. So let's talk about soybeans real quickly. When we look at soybeans, that's the really interesting crop going forward. The soybean balance sheet looks a little better. As long as China continues to be a good demander of beans, and we've seen the 2 to 3 million metric tons in imports this year, they like having corn, U.S. and Brazil as their exporter or supplier. That will continue to keep the bean market pretty well fueled going forward. We do see bean prices coming down. We see a lot more bearish factors than we just do bullish factors, and let me show you the demand curve here. There's probabilities for prices, and you can see they kind of waver under that $10 area going forward. And if you look at the stocks to use ratio, and we're kind of that 12% area, we're kind of hovering around that 11 to 12% area, we're kind of hovering around that $9 to $10 area. Prices have been the opportunity, and that's probably the last thing just to leave you with as my time is up. When you see these opportunities, and think about last spring when we saw prices go up on corn and soybeans and wheat after the crop report, or after the plant intentions, it's an opportunity to get stuff priced and put some money in your pocket. We had that opportunity with beans here, and we've seen beans come back off $10.50, and now they're back under $10. They were trading at $9.90 yesterday when I left the office. So we've probably, if you haven't taken advantage of it, you've probably unfortunately, you may have missed that opportunity on beans at this point because we see big beans coming down, big bean acreage coming down the pike at you. But you have to think about, if the market is giving you an opportunity to sell it at break-evens or above break-evens, then you need to take advantage of that. Don't worry about that last dime or last quarter bushel. Take advantage of it and go home. And as an old trader told me once, you can't go broke making a profit. So I will stop there. Thank you so much for having us. Thank you for having us back again this year. And I'll be around this morning, and I'll be at lunch, and I'll be in the booth at 2 o'clock this afternoon. So thank you for coming, and thank you for listening.